Julian Callow, Chief European Economist at Barclays, joins us to hopefully answer that question. We have, Julian, seemingly seen some relief in European equities, but if we look at CDSs, they're at the highest level since 1999 when it comes to insuring against Irish default. Why is that? Why still that uncertainty?
Well, I think this really surrounds just the issue of the Irish banking sector. You have had house prices in Ireland fall by 1/3 from their peak. If you look at Irish nominal GDP, it has gone down much more sharply than we've seen in any advanced economy in recent decades. For example, much more significantly than we saw the fall in GDP in nominal terms for Japan. If you look at the budget deficit, then last year, if you exclude financial bailouts, it was nearly 12% of GDP, including some of those bailout costs, it was 14.5% of GDP. The Irish government debt-GDP ratio by 2013, we think, will be at about 100%. As well, NAMA, which is the organisation that is taking Irish loans off banks, is another 25% of GDP. So that's why the markets have been concerned about Ireland. But there are also some elements which is worth being aware of on a more positive note there for Ireland, I think.
Well, you don't foresee a liquidity crisis there.
Well, the main thing is that there is a large amount of cash around that the central government has. Basically, in 2008, it was building up this cash very significantly, and it's been able to hold on to that cash reserve. It can probably use about 20 billion euros of that if it comes to it. Now, you're talking about an economy with a GDP size that's 150 or so billion euros. You're talking about net borrowing next year for the government, which is likely to be about 18 billion euros. So you see that the size of the amount of cash reserves in relation to the net and indeed the gross borrowing for Ireland is actually very substantial, and that provides a lot of protection from a liquidity perspective at the current time for Ireland, despite all the risks that are out there in the bigger picture.
So do you think then that it will remain that Greece is the only country in Europe with a debt problem that's going to have to go and ask for bailout funds here from the European Central Bank? Ask for help.
It's going to depend a lot, really, on how things play out in markets more generally and in the global business cycle. It might well be that it is only Greece. One important element of this is that the European Central Bank is implicitly providing a great deal of support to Irish banks, which of course the main source of the problem at the moment for Irish markets, way out of line with the size of GDP. Probably if you add together the total amount of Irish bonds that the ECB could have been buying here in recent months, plus the actual exposure from Irish banks financing from the ECB, you might be getting to 80 to 100 billion euros or so, according to some of our analysts, which would be, of course, a very large proportion of the total financing the ECB provides.
All right. Thanks, Julian.